You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Welcome back to this week's edition of the Systematic Investor Series with Moritz Siebert and I, Niels Kostrup-Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. For those of you who are regular listeners, our conversations are intended to keep you focused and inspired to continue your journey into this part of the financial world. And if you're new to the show, we hope that today's episode will trigger your curiosity to check out the back catalog and listen to the past episodes that you may have missed. Like last week's episode with Rob Carver, that certainly got us into some pretty deep discussions among the three of us. First off, though, Moritz, how are you? Good morning, or good afternoon, actually.
Good morning. Good afternoon.
It's about noon.
Good noon. It's about noon here in Munich. Freezing point, but I'm doing well. Definitely winter is on our doorsteps. And how are you?
Yes, same here. It's a gray day here in Switzerland, at least where I am. So, nice to be indoor recording a podcast with you. Now, in terms of a market wrap, of course, it was not surprising that it was a quiet week. We had the US holidays, of course, but a holiday that was celebrated by the Dow Jones climbing above 30,000 for the first time ever. I also noticed, in terms of other interesting news, that Peru launched $1 billion worth of a 101-year bond at about 3.25%, which is the lowest yield for an emerging market century bond yet. And of course, for some of those who really know their long, ultra-long bond history, you will know that back in 2017, Austria, our neighbor country here, issued a 100-year bond at 2.1% coupon. And actually that has, because the interest rates keep going lower, has gone up to a price of 226 cents, which is extraordinary, and a yield to maturity of about less than 0.5%. So, interesting stuff happening in that part of the financial world. Now, back to more familiar shores. We did see gold breaking through some interesting levels this week. It's now off about 15% from its peak this summer, where a lot of people were calling for gold to scream higher in terms of price. And of course, I'm sure we will get into a little bit of discussion about the moves in things like Bitcoin this week, which had it's had a massive uptrend, but it also had a decent pullback the last 24, 36 hours as well. So with all of that, Moritz, how was your week?
Another positive week, even though there have been, like you say, some very interesting price movements in a variety of markets. Well, I'm, up 11 basis points, so it's a positive week, but it's only very mildly positive. And I'm about 2% up for the month, still down close to 4% for the year. This is what it is. I'm really hoping that, December will be a turnaround December for me. Maybe I can, make the cut and scratch the zero for the year. That would be great. But who knows? We'll see. The notable winning positions that I spotted for the past week, I'm long the emissions contract. That's European Union emissions, so carbon emissions, since quite a long time. And emissions have started to move higher again. So I made good money from that position. And the notable losing positions were, I'm short crude, still short crude. Pretty much all of that year, I'm short crude. And WTI just behaves very strongly these past couple of days. I think it's trading around 45 now on the January contract. I'm short that contract, so that didn't help. And then, of course, I do have a long Bitcoin position, which has been so enjoyable, of course, in the past couple of weeks, and came a bit to a stop on Thanksgiving Thursday and then also on Friday. So it has been the largest losing position in my portfolio. And all the other markets, really not much. The bonds didn't move that much. I didn't see a lot of action there. Didn't see a lot of action from the currencies, to be honest. So pretty behaved.
Yeah.
Gold. You've mentioned gold.
Sure.
Gold had two interesting shots lower, right?
Yeah.
Really, really fast. One was yesterday, I think, from about 1800 to 1760 or something like that. And then the one before was on, I don't remember, maybe Wednesday or Tuesday, something like that, when it broke through the 1800 level. And I'm long gold, so that one wasn't great.
No, I don't know. I initially thought that maybe gold was just being sold off as people were buying more Bitcoin. I don't know. Maybe not. But there are definitely some very different opinions about gold. I've seen some people being quite bearish on gold in a bigger picture. And of course, we know a lot of people who are very bullish on gold in a bigger picture because we've had some of them on our global macro mini-series. So it'll be interesting to see now that gold has certainly broken through that low it made recently. We'll see how much more space it will get to the downside. And of course, it's not just gold. Silver is certainly a close cousin in this race. So there's some interesting stuff going on. I mean, on our side, like you, we actually, instead of having a small up week, we had a small down week for our trend following system, but still only a few basis points. A little bit up for the month, but still down for the year. So pretty similar picture. For us this week, energy is just like you. I mean, absolutely the worst performing sector by a long shot. Still on the short side in that particular sector. So we certainly suffer when things are so strong. I think the energies in general are up like 7, 8, 9% for the week. So pretty strong. On the other hand, to make up for all of that, we did make money in equities and currencies and grains. So that's why the week actually ended up being pretty even. Our volatility strategy, of course, the S&P were up for the week. And actually the VIX index reached the lowest level since the beginning of COVID-19 back in March. Now, the term structure is partly reflecting this new calm in terms of the shorter dated end of the curve. It looks pretty fairly normally priced, with December and January being priced in contango at the moment. But the longer dated VIX futures display kind of slightly unusual flat shape with virtually no difference between February 21 and June 21 futures. And at least historically or theoretically, there has been some, and I guess there should be some premium for providing liquidity to the longer dates. So we'll see what that all means. All in all, our volatility strategy gained a little bit during the week, up okay for the month, up very strong for the year. So it's continued to be an interesting area in terms of market action, I guess. Now, Moritz, we do have some great questions coming in from Jean, Werner, Terrance, and Sebastien. The first one, though, came in as a voicemail from Jean, New Zealand, a while ago. Actually, I have to really apologize. It must have gone into my junk folder for some reason. So we're going to now play the question from Jean, and then you and I can have a little bit of a conversation. Let's hear what Jean had to ask us.
Hi, this is Jean from New Zealand. I'm developing a trend following model using simple moving average crossovers, and I'm tuning the parameters of the model using machine learning against a historical data set. My question is, should you remove periods of the historical data set to make the data more representative of either the wider historical data that you might not be able to get your hands on, or maybe more representative of the likely future events? Obviously, we're not in the game of predicting the future environments here in trend following, but it might be obvious that the 20, 40 or 60 year data set that you've got underrepresents or overrepresents certain secular trends, or the data set you've got might have one boom and two recessions just because of the coincidence of when the data was first gathered. So I'm interested to hear your thoughts on this compromise.
Okay, so essentially it's a question about historical data when developing trading systems. And I think what Jean is asking is whether it's okay to kind of ignore some of the historical data if you don't think it represents what the environment is at the moment. What are your thoughts on this?
Well, my thoughts is I can only let you know, Shane, what it is that I'm doing. I'm using all the data that I can get my hand on. I think data is valuable. It's kind of like the fuel that I need in order to do my research. And I'll just, mention that many large trading firms out there, CTAs out there, Winton, for example, Winton is addicted to data, right? They're trying to get as much data as they possibly can, century-old data, everything they can get their hands on. And the markets are the markets. And the history of transactions is reflected in the time series of price data that you get. And this is valuable information to me. So I don't want to be dismissing any of the data, throwing it out of the window or not use it, only because I think that maybe what is happening today might be so different, or what will be happening in the future might be so different that it would never have been possible to see anything like that in the past. I don't do it that way. And also, I do not apply machine learning techniques, but that is probably just a limitation on my end, whereas I simply do not understand those techniques well enough. I don't know exactly what they do, and I wouldn't know even how to use them and how to interpret the results. So I stay away from it. And I've mentioned that before. I'm still waiting to see the live track records of the really successful, pure machine learning, AI-driven funds, that really kick the ball out of the park. And I haven't seen any yet. So maybe they're under the radar and we don't see them because they don't show them to us and they're trading proprietary money, all of which may be true. But I have yet to see a public live track record of a machine learning or AI-driven fund with substantial assets under management that has really kicked the ball out of the park, so that they can say, here it is, I have the secret sauce and I'm doing something better than all of you guys who are not using AI techniques. So I think right now my skepticism is warranted and fair. I may be proven wrong, as I have been many, many times going forward. So, but I would just use all the data. I would not throw out certain episodes or certain periods of the historical data set because you think they're no longer representative of today's environment. There's enough surprises in there in the historical data, and we will get surprises going forward. Of course, they're all a little bit different. COVID-19 is a different type of crisis, but it is a crisis nevertheless, right? So I don't want to remove the COVID crisis from the data when I do back testing or research on my system, say in 2022, saying, well, this has been a once-in-a-lifetime event. It's never going to be happening again. So therefore, I'm removing the COVID event. I don't do it. So it's a matter of choice.
Yeah, no, I think you touch on a lot of interesting things. And Jean's question does actually raise a much bigger debate that I'd like to thrash out a little bit today with you, Moritz. But the first thing that springs to mind is I think that's a great thing for Jack Swagger's next book, The Machine Learning Market Wizards, right? Let's have one of those.
Come on up.
Yeah, exactly. Anyways, back to your question, Jean. I think what Jean is raising in terms of an issue is something that I think we all struggle with to some extent, and that is, at the end of the day, how do we pick parameters, right? Because there are so many different ways of doing it, and there are so many different schools of thoughts in terms of what data should we use. Should we do walk forward, and should we feed it all the data and all of those things? And I think it's a really hard question to answer in terms of what's right and what's wrong. I think to some extent it comes down to your beliefs at the end of the day, what you think works best. But it can only be an educated guess because we, as you said, Moritz, we don't know what the future will hold. So I mean, I'm in the school of your thoughts as well, Moritz, in terms of, the history is the history. We can't change that. So we need to use it. And you say you want as much data as possible. And I agree with that in many ways, right? But then I was also a little bit surprised when we had Perry Kaufman on a few weeks ago. And I suggest, Jean, you go back and listen to that episode because he was saying, well, one way of getting around this to some extent is to continuously select those markets that are doing the best in the quote-unquote current environment. So he would measure the performance of the various markets. He'd trade all markets equal, so same parameter sets, but he would choose the markets that were doing the best on a rolling 60-day time frame. So on one hand, I can see that it makes some sense to say, yeah, if you have a market and a parameter combination that are really in form because of the way the markets are, you should go with that. But on the other hand, you end up with the same problem, and that is you don't know just because it's been doing well for the last 60 days whether it's going to do well for the next 60 days. And I don't think we can get around that issue, whatsoever. So I lean towards the fact that you should take as much data as like you said, Moritz, because at least you could say the model has to be able to cope with many different things and in many different environments. And it's never going to be the best model, but it's going to be as robust as possible. Because I think what we all are striving for in our system design is robustness. The problem is robustness is really difficult to define. But I think for me, at least, robustness comes from having dealt through many different times of environments and surprises and all of that stuff. And this is also why I have a very strong conviction when it comes to trend following, because I really feel that trend following is one of those strategies that have proven with real trading, because we can go back and find managers with long track records, that they have survived. A lot of these other strategies are relatively new. We know a lot of money went into, say, risk parity, et cetera, but that strategy didn't get known until 2003 when Bridgewater started doing it and allowing people getting into it. So we haven't seen that many crises and different market situations in the last 17 years compared to the last 50 years. And we know that there are managers with 50-year real track records. And of course, I work for one that has a 46-plus year track record. So we know it works. And I think that is more important. So for me, robustness, even if it means that I don't have the quote-unquote best parameters, is more important, because I don't think that you can find the best parameters for an unknown future anyways.
Agreed. And I would have a problem to decide where to stop and where to end. What data do you exclude and what not? Where do you make the cut? What is crazy enough so that you could say this is worthy of exclusion? And this to me is impossible to answer, because you may look at, say, the stock price of Tesla these days. Yesterday it closed at 584, a new all-time high for the stock of Tesla. We all know what happened to the price of Tesla this year. Up massively, right? Is this crazy? Yeah, to some people. I mean, there's many people out there, many voices out there that say this is completely over the top. This is massively overvalued. The company doesn't turn a profit. It is just, Robinhood traders, momentum, whatever it is, short gamma dealer hedging, yada, yada, yada. But still, those are transactions. Those transactions happen right now. They are executed or they're driven by human beings who may be using machines to do them, but it is reality. It's on the tape. Whether you think that's crazy or Tesla doesn't deserve that price, it doesn't matter. That's just your opinion. But the fact of the matter is, the very objective fact of the matter is, it has printed to the tape, and Tesla is at 584 today, period. And I think include that data point. It's there. Work with it.
Yeah. And one thing we can say for sure, Moritz, and that is those people who are trading Tesla using trend following rules, they will be still long Tesla.
Exactly.
That's a fact.
Certainly know of one person who's long Tesla, and
he will be on the show very shortly, right? So
Exactly.
So this is the thing about trend following and the strength of that when you see these quote unquote unusual moves or crazy moves. But let me go and completely digress from this particular topic by making a plug for an episode I'm going to release next week, because I brought back one of the guests that I had on back in 2015. And this guy predicted, because he's in the world of predictions, that Dow Jones was heading to 32,000. And so as we get closer to that, which of course back then sounded crazy, but now we're getting close to it. Anyways, it's a guy called Mahendra Sharma, and he's going to be back, and he writes every year a book with his predictions. He's obviously not using trend following, I can assure you that, because we don't predict. Nevertheless, it's really interesting. And by the way, just as a little cliffhanger, he has predictions about Tesla. He has predictions about Bitcoin. So there's a lot of good stuff in that. But you have to be patient a few more days and go and check out that episode. It'll be different, but nevertheless, I think it was a really interesting conversation. So let's move on. I hope, Gene, that it was worth the wait, that you got a long answer about this. And by the way, I will suggest, because you should Twitter Moritz and me, and with your comments about a topic like what's the best thing to do about backtesting, selecting parameters. Let's hear your opinion. We may not have the right answer, so let's have some more opinions about that. So do that on Twitter. I know Moritz in particular is very good to respond on that. I'm maybe not as good as, but I'll do my best. Now, the next question is from Veyana. And Veyana says, "Hi Niels, hi Moritz, still loving every episode and learning from you each week. I have finally decided that 20-day breakouts no longer work, as Jerry and Moritz have been saying for a long time. But I guess I had to learn the hard way. So I'm now only looking at medium-term 20-plus days breakouts. However, the number of signals under the longer-term breakouts are reduced. What I find is that I wait patiently for a 35-day breakout, e.g. I go long at a price of 100 and then often see my stop getting hit at 95, only to see the market then continue in the original direction of the breakout. Only now I'm out of the trade. Now my question, should I then go back into the trade at the original 35-day breakout level and buy a price of 100 in this case, of the trade that just got stopped out, or should I reset and wait for the next 35-day high or low to put on a position?" So thanks for the question, Veyana. Let's hear what Moritz has to say.
Do the trade, for sure. Do the trade. If you do not do the trade, you cannot make the profit from that trade. You need to bake that into your systems rules, right? But you need to also come to terms with a situation such as you're taking a position and it hits your initial stop, you're out of that position. You're doing that again, it hits your initial stop, you're out of the position again. You do that 5 times in a row. Then you finally get that position, it moves your way, and it eats into your open trade equity, and it maybe becomes a scratch or just a mild positive win. But you have to do these trades over and over and over again. And I know it's very difficult to pull the trigger every single time on a trade that has cost you money in the last couple of iterations that you traded that market. But yet you need to take that trade. It's very important, because this one, if you miss it and it goes to the moon, this may be the trade that you really need. You just don't know that. So you must take all the trades. That's kind of like one of the 10 commandments. The system signals are there to be obeyed. They're not there to be questioned, second guessed, or any of these things. So please take the trade.
Yeah, completely agree on that point, Veyana. What I will suggest, though, is that you might, and obviously it depends on what your what software platforms and skill set you have in that sense. But I do think it's worth doing a bit of testing, right? Because you may just be putting your initial stop too close, right? I mean, it could be that you find something, and again, I don't want you to over-optimize, because just picking like 34 days instead of 35 days, it's not what I'm trying to say here. What I'm trying to say is I think you need to look at a number of different combinations with your entries and your initial stops and your ongoing stop loss rules, etc., just to see whether there is a way for you to improve the system. Because once you have the system, as Moritz says, you need to do the trades, because otherwise your backtest becomes meaningless. You can't even use it for anything if you don't follow exactly the same rules as you did in your backtest. So that's super important. I mean, go to the 40 in, 20 out website, because there Andrew actually does show a lot of these things. I mean, his time frame is obviously not that different to what you're describing, right? But he does show, the fact that you have sometimes many trades in a row that just goes against you, and that's where your risk management comes into play, so that you can sustain a number of these losses. I mean, we all have them, and a year like this is one of those years where there's just been a lot of losing trades and false signals. They come, but as Moritz said, you need to be prepared for the day when you get the trade and it just flies. A little bit if you were trading Bitcoin this year, right? Then you might have had a few false starts 6 months ago, but when it went through whatever level it hit, it just went higher. So taking all the trades, that's definitely rule number one for sure. Good stuff. Thanks very much for that, Veyana. Next one is from Terrance. Terrance writes, I don't want to sound like I'm flogging a dead horse on the topic of volatility parity, but I do have a burning question. I'm a big fan of volatility parity and agree with Moritz on the simplicity and the robustness of a simple volatility parity strategy. However, when it comes to using ATR-based sizing, i.e. buying or selling based on a standardized unit of risk, I find it difficult to control the leverage of the overall portfolio as the sum of the weights would not add up to one. I could, of course, set an upper limit on the max exposure per position to ensure the sum of the weights is always below 100%, but that would defeat the purpose of using volatility parity and not a particularly elegant solution. What are your thoughts on this issue?
Question, is there a reason to have the sum of percentage weights sum up to 100%? I don't know. There's no reason for me. My portfolio is leveraged. I have a certain amount of equity, so that's, cash, real equity in the account, but the notional position size that I trade relative to that equity is greater than the equity, right? So I do use leverage. And I think this is true for most CTA trend following traders because you have a relatively large position size already to begin with on short-term interest rate futures and bond futures, etc., right? Where you're going to have much more positions on or much more notional risk on than in net gas, for instance. So this is the nature of the beast, right? Of an ATR normalized position sizing or a volatility normalized position sizing process is that some of the positions are larger in notional terms than others, but they are the same in ATR or volatility terms. And this is what's important to me. But of course, when you do the sum of the weights in volatility terms, then you will find that, short-term interest rates and some of the currencies and the bond futures, they have a very large weight relative to natural gas and Bitcoin. But in volatility space, they are normalized. And that is what's important to me. I'm not fussed about any of these weights summing up to 100%. I control my portfolio leverage by, finding a level of risk that I'm willing to take in relation to my equity, right? So I'm risking a certain amount of basis points with each position that I take. And I do that over and over and over again. And that produces a certain, margin requirement that I have over time, which, fluctuates, but it is, say, between 20 and 25%, something like that. And I'm just fine with that. It's dynamic.
Yeah. So to expand a little bit on that for you, Terrance, what I might, if in that position, I might do the following. So before I joined Dunn, I had my own CTA and we developed a trend following system back in around 2006, 2007. And I still monitor that system to see how it's doing and so on and so forth. And that's not using the same techniques as we are at Dunn. So it is more closely to what Moritz is doing in terms of sizing of positions, etc., etc., etc. So in that sense, you're right that you don't have, essentially, you're not managing the risk on a portfolio level. You're taking the trades with a certain risk, and therefore your risk to stop will fluctuate every single day. But I think that's the first thing I would do, actually, is to start monitoring the risk to stop and just see what it looks like. Is it 5% if you got stopped out of all your positions? Is it 25%, or what's the number? Just for you to be comfortable with that level. Now, it doesn't say anything about what your potential drawdown could be, because you could, as we just discussed in the previous question, you could have 5 bad trades in a row for a number of those markets, right? So only that you can see through either trading it. So the future will give you a good handle on that. Or of course you can do your back testing and get an idea of that. But one thing I've learned over the years as a kind of a rule of thumb that I think is reasonably accurate, and that is to say that you should expect your drawdown from a model like that to be about 5 or 6 times your monthly volatility. So if you have a standard deviation of 5% in your back-tested results using your methodology, you should expect that at some point you get a 30-40% drawdown. That is not uncommon. So there is just no way of being absolutely certain about what your risk, i.e. drawdown, will be. And by the way, that leads me to another topic I would love to get you guys involved in out there who obviously are looking at different things besides what we talked about earlier in terms of what to do with parameters selection. I would love to hear, and I think Moritz as well, we would love to hear what your thoughts are in terms of what's a good metric for calculating risk-adjusted returns. How do you, because you can use Sotino, et cetera, but actually I'm at the moment really interested in finding good ways that also takes into account the fact of the drawdown. So in our own little Slack group that we have from those people who attended our live event last year, there are a couple of suggestions, but I'd love to hear everyone's suggestions about what's a good way of getting a handle on the risk-adjusted returns of, say, a trend-following strategy that also looks at not just the volatility of the strategy, but actually also essentially the pain of achieving those results, such as the pain-to-gain ratio that we know that Jack Schwager really likes, but there are others out there. So anyways, just a little thought on that as well. Last question for today is from Sebastien, who just managed to get it in before we hit record. So well done for you. And by the way to get these questions answered by Moritz and me is to send them to info@toptradersunplugged.com. Then we will bring them up as soon as we can. Last question is from Sebastien, and he asks, how do you separate your self-worth from your net worth? Is it a process you have to learn over time, or did you never had big issues with losing money affecting yourself? Thanks for a great podcast. I'm a weekly listener since the time you started the podcast. Well, that's fantastic, by the way, Sebastien, because it has been a long time since TTU started. So thanks for that. But anyways, Moritz, how do you separate your self-worth from your net worth?
Yeah, I'm not sure if it's a fair question. I'm not sure if I agree with how it is phrased. I hope that all of us have a self-worth that is, more meaningful than just of, our trading results, be it family and friends and what you do in the world. I mean, I hope at least that is true for me. I want to see myself in that way, that it's not all about trading. Trading is a thing that I do. I do it to make money. I really enjoy doing it, but there's more to life than trading, obviously, right? So I guess the question is more, how do you let the effects and the results of trading affect your emotional stability, your mindset, right? Your way of being. And of course, this isn't easy. I think experience is a great teacher here. You cannot simulate that with a paper trading account. It just doesn't work. I think you have to do it, and you have to come to terms with the fact that you will have losing periods, maybe even severe losing periods, long-lasting losing periods. There are a couple of techniques which I have mentioned before on the show that help me tackle these episodes and handle them well. And one is to, always remind myself that, there is a better period hopefully ahead. There's no guarantee, but I know that, when I am making money hand over fist, I want to remind myself, just, stay even keeled. This money may be going away before you know it, right? And it just, goes the other way and you're in a massive drawdown. And sometimes it can be really quick. But I also want to remind myself of the many periods that I had where, I was very fast to at least reduce a drawdown substantially, right? If you're down minus 30 and you can reduce that to being down minus 15, that already feels good to me. It's still a loss, right? But if you're at minus 30, that is really, really bad. Going back up to minus 15, yeah, you're not yet positive, but still you're kind of like in a different risk zone there, right? So you're getting back in a more balanced way. So I like that. I also don't want to have a look at the dollar numbers all too often. I really want to stay as much as I can in a percentage world and have things normalized. How does my account behave in relation to the notional account size that I trade, in relation to the equity that I trade? Those are percentage numbers. Those are not dollar numbers, right? That kind of like normalizes it for me, and it has the benefit of not then playing with my mind too much. So this is how I do it. And I also must say that over the years, I've just become much more thick-skinned about these things. 10, 15 years ago, losses have affected me much, much more and much more negatively than they do that today. So today I can really have losing days, even large losing days. And you wouldn't see a grumpy Moritz down at the dinner table. But 10, 15 years ago, there would have been a grumpy Moritz down at the dinner table. So I'm getting better at that. And this is what we've said before, or many times, Niels, it's also about the journey. This is something that you just get used to, I think. And, I know traders out there, and you know them as well, Niels, who are trading substantially greater volatility than you and I. And they're doing it for 30 years or something like that. And they are really swinging for the fences, and they have some massive down days and some massive down month. And, when I speak to them, and I don't speak too often to them, but I do speak personally to them, they're just, you wouldn't notice it if they had a massive down day. It's just part of the business. It's you breathe in, you breathe out. If you run a business, because it's really, they consider trading like a business. You're running a trading business. I think this is really true. You're running a trading business. There's no business in the world that just, maybe there are, but most businesses don't just make money every day. You have costs, you pay people, right? Then you have something affecting you. Your business just doesn't run as you expect it to run. There's a fewer amount of customers. Your product isn't well received. There's a lawsuit, yada, yada, yada. There's always volatility. So it's like a business. Don't expect it to make money every day, every month, every year. You will have losing trades. You will have losing periods. And you just accept that and pull the trigger again on the next trade. If you have an edge in your system, over time, it'll show. And this is what keeps you going.
Yeah, well said. And I don't really have much to add to that. I think, Sebastien, Moritz has said all that needs to be said about this. It is definitely a journey. I will say, and just being very raw about these facts, that even after more than 3 decades of doing this, I still don't feel great when we're in a big drawdown. I have to say, I don't feel great about it. And I will remind Moritz about the conversation we had on the podcast. I don't remember when it was, like a year ago or something like that, where we all had just a crap week. We lost like 10% from the bonds or whatever it was. And you can hear it in our voice. You really can, that was not one of the best weeks we had in our recent history. So I think as much as we want to say that we get better at it, I think we also want to say we're really human about it. And we're very humble about what markets can do to us, right?
Of course. We're not robots. It doesn't go away completely. You don't get it down to like 0%.
But it's the small improvements,
there,
right?
So how do you handle it?
Yeah.
And how do you put it in perspective?
Yeah.
That makes the difference.
Yeah. And I will say that I think it's, as Moritz said earlier, it is a journey. And I do think you make these small improvements over time, but it doesn't mean you can't get knocked off course from time to time where you just think that really did hurt. So, and I think a lot of the people listening to our conversations, I'm sure have had these experiences. But as you also said, Moritz, there are people, and certainly I know that from our firm. With someone like Bill Dunn, when he was in the office every day, you really could not tell whether it was an up 10% day or a down 10% day. There's just no emotional impact. So the thing about treating it as a business and it's a journey that's bumpy, absolutely, that's the way to look at it. But it also makes it exciting and unpredictable. So anyway, speaking about exciting and unpredictable, we have the numbers for where we are performance-wise, and then we'll get to our new segment about what stood out to us in terms of new content that we came across this week. Anyways, it has been a good month so far for the Beta 50 index, up 2.75%, now up almost 1% for the year, so back in the black. The SocGen CTA index, although it's a good month, up on 1.5% almost in November, it's still down 2% or so for the year. Trend index, up 1.25-ish and down only about 20 basis points now for the year, so coming back. The short-term guys doing well this month as well, up 58 basis points, up 2.4% for the year, whilst the multi-alternative risk premium index is down almost 1% again in November, down 15.6% for the year. So that road downwards continues, unfortunately, for those strategies. As I may not have said so far today, if you want to help us out, you could leave a rating and review in iTunes. They really do help. Or just share the content. That's really all we ask for. That is so important. Now, Moritz, I'm a little bit unprepared for this next question myself, I have to admit, because right now I'm kind of blanking on which podcast I listened to this week. So I'm going to let you go first if there's anything that stood out to you in terms of content while I'm struggling to come up with what I've been listening to this week.
Yeah, that's fine. I must admit I only listened to 2 podcasts this week. It's been a busy week, but everything in the last couple of weeks and also this week was about Bitcoin, right? So my interest right now is really in Bitcoin. There's a podcast called What Bitcoin Did, and there was one show where he interviewed the Vinklevoss Twins, who run Gemini. And then there's been another podcast, another show, where they had an interview with Mike Novogratz and Dan Moorhead. And obviously, they're all super Bitcoin bulls. So no question what their views were, right? But they're coming from different angles as to, why they think it is a valuable asset, what makes it an asset in the first place, what narrative they prefer, whether that's digital gold or a payment system, and what could really be happening to the price of Bitcoin and the institutional adoption that may be on the doorstep, et cetera, et cetera. So I'm not sure if all of that is going to play out as they think it will, because if it does, then they're all saying 2 to 3 years from now we're at 500,000. Well, that's a big number, but it's interesting to hear those different perspectives.
So you bring up Bitcoin, and I know you obviously know a lot more about Bitcoin than I do, and so on and so forth. But since you mention it, I actually now remember that I did listen to a podcast this week as well on the topic of Bitcoin. Would you believe it or not? But it happened just to be on the Investors podcast, and I like those guys. So Preston has a new weekly show on crypto. So I actually listened to that. It was very educational for me because it was kind of, what is Bitcoin and et cetera, et cetera, et cetera. But here's a question, and I know this could get me into trouble, but I want to ask it to you anyways, because I really don't mean anything. I don't want it to sound like that I have an agenda here. I don't. Completely neutral on this. However, when you see the Bitcoin crowd, Moritz, and I would say you're part of it, but I'm not putting you in the same box as the people that I'm going to refer to now. But you see the people who have adopted Bitcoin the last few years, and we know a lot of them ourselves. And as you say, they're very vocal about it. They're very bullish about it. But they also have big audiences, right? So a lot of people follow them. And this is where I'm a little bit in conflict. Because when you take people with hundreds of thousands of followers and they keep on going saying, buy Bitcoin, it's going to 100,000, 280,000. To me, that is a little bit of a pump and dump scheme. I don't really see the difference. And the reason that I bring that up is because in Jack Swager's last book, there was a guy who made a lot of money from a pump and dump scheme. Now, he wasn't doing the pumping and dumping. There were other people doing it. He just happened to make a lot of money on that trade. So I think personally, there's a little bit of a difference when you go out and you kind of pump your narrative in that direction, knowing that you have a large audience, but you do it in a small market like Bitcoin, compared to if you were just going out and saying, oh, I'm really super bullish treasuries, because you're not going to move the market by saying you're really bullish at treasuries. But when you have hundreds of thousands of people following this group of content creators that are so one way, and even if they truly believe it, I'm not saying they don't, and of course they own the something like that. I just think you have to be super careful with a small market like Bitcoin, because you are impacting the price. You are manipulating the price, in my opinion. That's my question, and I know it's a little bit controversial, not to you, but just generally speaking.
Yeah, of course, there's a lot of noise around it, and it's the more the price goes up, the more attention it gets, and I think that's natural. I don't think that any of the people that you're listening to on the big podcasts, or like, say the Novogradzes of the world, or the Vinklevoss Twins, etc., I don't think they're in the business of dumping. I think they're in the business of collecting Bitcoin and putting it into ice cold deep storage and hodling it forever, right? So if it goes up, of course they benefit, but I don't think they're doing this pump and dump type of thing scheme where they pump it up only to sell it to the next fool, right? And then wait for the price to crash and buy it back.
What's the point, Moritz, in having Bitcoin if you're not going to sell it at some point and take the profit, right?
It is an asset. It's a value container. It is a storehold of wealth, right? It's you have a lot of people that put money into, say, gold, right? They're not incentivized. They're not planning on selling their gold. They have it as a storehold of wealth because they know it, deflates lesser than, or it loses less money, less purchasing power than a fiat currency. And that is true, right? So it's kind of like this asset container. And I really do like the narrative of Bitcoin being digital gold. It is a better form of gold when you think about the properties of gold, right? It's very difficult to move gold from A to B. I cannot, I would have to drive to Zug and bring you a bar of gold, but then you have to smelter it and, do something with it. It takes time. It's really heavy, right? It's not as fungible. Bitcoin's electronic. Everything's on the blockchain. And you know what? It is disinflationary. There's only going to be 21 million of these coins, never a single one more. Actually, that's a number that will never be reached because, it's asymptotically getting to that point, right? But around the year 2100, we will be getting close to the 21 million mark. But gold, the production of gold is very bad for the environment. All the chemicals are thrown at the thing, right, in order to get it out of the earth crust. And it does inflate. People tend to forget about that. But the stock of gold per year increases by about 2% or 1.7 or 1.8% or something like that on average per year. Bitcoin's the opposite. It is a really cool narrative that I think has some appeal. And I also think that this time around, in contrast to what we saw in December of 2017, when Bitcoin was getting close, or when Bitcoin was trading at 20,000, it is, of course, retail is in there, right? Retail is always in there. But in 2017, it's only been retail. I don't think that any of the, say, family offices or some of the more professional type of traders / investors had too much of an exposure to Bitcoin in the run-up of 2017. That was pure retail. But clearly this has changed. There's now PayPal, there's Stripe, there's MicroStrategy, right? The integration of Bitcoin into the financial system continues to happen, and it has gone a long way from 2017 to where we are today. So high net worth individuals, family offices, etc., they are corporates. They are in that asset right now. It's not only just retail. And take my word for it, there are quite a number of large institutional players right now preparing for allocating to Bitcoin because they can no longer sit on the sidelines and say, I'm not touching it.
But to me, that's part of the hype. All that narrative, right? All the people saying, oh yeah, but Microsoft, they're going to take 1%, Apple's going to take 1%, Amazon going to take 1% and put the money. I mean, again, I'm kind of open about it, right? In a sense, it's to me, it's kind of one market like any other market in some ways, right? But on the other hand, I also would say that, and no, I'm not going to get popular among the Bitcoin crowd for saying it, but to me, it's nothing. It's kind of a Ponzi scheme that only gets more and more valuable because there are fewer of them. And there was a tweet this week, not maybe yesterday or the day before, showing how few people were controlling or holding most of Bitcoin's outstanding, whatever number it is, right? So it's kind of, in a sense, to me, controlled by few people. It's and again, I don't actually know the details here, but from listening to Preston's conversation with, and I forget, unfortunately, his name, was very knowledgeable about it. They talked about, and now I'm really getting into deep water here. They talk about something like full notes, but and how that changed in order to increase the volume of Bitcoin. Something had to change in order to increase that a few years back. And on one hand, I hear that people saying, oh yeah, but Bitcoin, it's decentralized, you can't control it. But on the other hand, I hear, if I understood correctly, yeah, but there are a few groups of people, there are a few people, maybe the original nature of this protocol, that got together and decided that something in the protocol changed in order to allow for more volume, right? So to me, it's not completely impossible to change Bitcoin. And that may be wrong, that may be right, but that's how I understand it. So I have very mixed emotions about an asset like that, because, I mean, you could have decided to use a limited edition of Lego and say, this is now really valuable and there's not going to be any more of these and we're going to keep it as a store of value. Bitcoin, to me, it has no real value.
I think there's something different, until, at some point somebody decides to produce the next Lego block. With Bitcoin, you would have to get, kind of like the majority of the hash power needs to agree on that change to occur. And so this is, yes, there can be an attack on Bitcoin. I don't want to say the probability is zero, right? It's just the amount of hashing power that is, underpinning that protocol is now so large that it would take a massive effort and a lot of money to really attack that protocol. So, but yeah, I mean, the risk is not zero. I want to be, I am not in the camp of running out there in the front of my house with a Bitcoin flag and a Bitcoin mask and a Bitcoin t-shirt and screaming Bitcoin all day long. That's not me, right? I'm more like you. Yeah, it's an asset. I can come around to that digital gold narrative. Fine, that works for me. Other people see other things in it. Everybody's a little bit different. But really what it is to me, and I've said that before, is it is a risk worth taking as a trader.
Yeah, sure.
Because I think it is a lopsided risk return profile. It's like an option, like a call option payout possibility. It may not pay out, right? It may go down. Fine. But it does have that asymmetry built into it without me paying an option premium to get that exposure, right? Maybe it does go to 500,000, maybe it does not, maybe it goes to 1 million, maybe it goes to 100,000. I don't know. I really do not know. I'm not in the business of making any forecast. But it could, and it could also go to zero, right? But I can control my risk through position sizing of that exposure. I don't have all of my assets and all of my money in Bitcoin, right? But I have it's become larger recently, but I do have an exposure to the thing, and I think it is a great bet. So everybody needs to make up their own mind.
I think that's a fair argument. I mean, it's a market like anything else, and of course, you're absolutely right. I mean, especially if people keep talking about it with large groups of following that it's going to go up, then more and more people will end up buying it. So that's perfectly fine. What I found interesting was actually that in the last couple of weeks, I've heard Ray Dalio I've heard Jim Rogers, by the way, he had a very good conversation on the Grant Williams podcast recently, where they also talked about Bitcoin. And another guy that I follow a little bit on the side called Martin Armstrong, just because he used to do some cycle work, or he still does, but I guess he's changed a bit. But anyways, all three of them said that they fear that at some point, and actually we heard Julian Brigden talk about that with us, Moritz, when we did the Global Macro interview, they all fear that as Bitcoin becomes maybe too valuable in however we define that governments are just going to outlaw it and ban it, like China has done. I think other countries like Abu Dhabi has done as well, and things like that. So I just think it's kind of interesting
I don't. This is really where it can happen, right? But I don't think it will happen. And think about it that way. I think Bitcoin is going to be integrated into the financial system. If you think that you should be in Bitcoin because of secrecy and you're doing dirty tricks with it and you're not going to be seen, then I think you're backing the wrong horse. I think, Bitcoin, as you know, is not anonymous, it's pseudonymous, and there are techniques, to kind of like light it up. Everything is on the blockchain forever, right? So I don't think this is a place to hide. You will be taxed on it. In the US, you have to declare it on your tax statement, right? So all of that is coming. But why would a government outlaw it, knowing that if they did that, it's a global market, that's the internet, right? The Bitcoin goes to a country where it's still accepted. It leaves your country, it goes to another country, and there's the business going to be built around it. But why not just accept it in the same way that governments accept and tax the possession of gold? Gold is not the funnily printed colored paper that you pay your, groceries with. You're using your Swiss francs for that, and I'm using my euros, right? But you can have gold. Why wouldn't governments allow the possession of Bitcoin in the same way they allow you to possess gold, silver, platinum, palladium? Just this one is in digital form. And if it increases in value, you're making a gain on it, then you tax it when you sell it. And that's it. I don't think it will ever be a competition to the monetary system because, the governments and the central banks, they're not going to surrender that privilege, right? And they will come up with their own digital currency and their own protocols where they can, inflate the monetary supply and the monetary base, or whatever it is that they want to do with that thing. And they will say, here's the digital euro. And your salary, your people that work at BMW, your salary is paid in that currency. That is our legal tender. It's not Bitcoin. Bitcoin is just an asset. You can buy it.
I think you almost gave the answer I would give in terms of why I think it might get banned. And that is exactly why, because they don't want competition when they come out with their own digital currency. It's similar to right now, you can't go out and get another US dollar. There is only one US dollar, right? There's no competition to the US dollar. And so I don't think they want a competition to their currencies when they do come. And therefore, I think Bitcoin and all the other stuff, this is my guess, could very well come under attack from them. And as Jim Rogers, to quote him, said, I mean, you could just say that to have Bitcoin or to even trying to pay with it is treason. And then he didn't think that a lot of people would keep their Bitcoins, right? So, I mean, I'm not saying that that's what they're going to do, but I do think it's interesting when you hear people like Jim Rogers, Ray Dalio, and all of that. I mean, they do often have the finger on the pulse, even though I'm sure you can find many other people saying the exact opposite. But anyways, I didn't really even mean to go down the Bitcoin rabbit hole today, but since we had a little bit of spare time, it was interesting and educational for me, since you know a lot more about this than I do. So on that note, Moritz, anything else you want to bring up in this very wide-ranging conversation today?
No, I think we're good. That was fun.
It was fun indeed, and as Moritz alluded to earlier today, we will have Jerry back soon. Sometime in December, he will come and join us, and we're going to talk all things trend following, open equity, closed equity, lots of good stuff when he joins. So we very much look forward to that, and maybe we'll find some other guests to come along in the next few weeks as well. Do send your questions to info@toptradersunplugged.com. Do bring up these topics that we talked about, risk-adjusted returns, what's a good metrics for that, how do you decide on parameters. Let's have some debate about that. You can send it or do it via Twitter. I'm sure you know what our handles are. In the meantime, from Moritz and me, thank you so much for listening, and we look forward to being back with you next week. And in the meantime, stay healthy and be well.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.